welcome to Business Bits.
Welcome back.
As you can see, we're in a little bit different of a scenario here because we're actually in Chicago today, but we took the show on the road and we're going to bring you a Business Bits where, Dad, we're going to go over today a couple strategies that business owners can use to build their nest egg, because you and I both know business owners have a unique situation. They have to handle payroll as well as create their own funded retirement over the course of their lifetime.
That's right.
And when they accumulate their assets, sometimes they don't know exactly how to go about building a nest egg. And that is one of the biggest problems business owners have when they transition away from their business. Taking the money they have, putting it into vehicles that are effective and efficient so they have a nest egg that's going to create income for the rest of their life, or at least some sort of income. Because business owners step away, they lose what they once had.
Well, business owners, entrepreneurs at heart, have a passion usually for their business. And I love that book by Michael Gerber. He wrote it years ago. It's called The E-Myth. The E-Myth. And the E-Myth is the entrepreneurial myth, meaning most people that go into business were not really business owners to begin with. They were tactical workers. For instance, you got an engineering degree and maybe you worked for Pratt Whitney, but then you decided to venture out on your own because you wanted to have the freedom of controlling your own destiny. The challenge is then you don't really know much about business. You know the tactical work of being an engineer, in that case, an aerospace engineer, but you don't really know many of the facets of business. So you have to discover these epiphanies along the way, everything from meeting payroll to marketing to strategic budgeting and planning to compliance, etc., etc. Well, one of the reasons you and I are here, Mike, at the Athletic Club here in Chicago is for training ourselves on both the business building aspects and the investment advisory aspect, which is uniquely to the nature of our business, but we encourage you to do that as well. Really getting educated and surrounding yourself with a network of persons, or at least one individual advocate that you can have a confidence in that can help guide you in the areas that you're weak in, because we all have foibles. None of us are perfect or have cornered the market on all good ideas. So that's why we're here, and that's why we're coming to you from the road here at the Chicago Athletic Association, right across the street from the famous Chicago Bean at the base of 12 South Michigan Avenue, just below the Magnificent Mile, which is a great place for you lady friends and gentlemen that love fashion to go shopping. So we're excited to be here with you. We're going to have a little bit of fun the next couple of days, but Michael and I are bringing you this show just to kind of stay in touch while we're out of the South Florida area for the moment.
Yep, and I want to take it back there for a moment because I know you mentioned education. And it seems to me within our office that really is the first step, because a lot of business owners know how to accumulate assets, but they really have no idea or a very small idea of how to go about turning those assets into income streams or cash flow. Because they have the cash flow when they're in their business, but when they step away, they don't know how to turn maybe $1 million into cash flow on the back end. And I think you mentioned it there. It kind of starts with that education aspect.
It really does. You know, the other day we were talking about that couple that have an oxygen and an aromatherapy business. They actually make the equipment for that business, and they're selling it for a one-time price tag, which is an uber amount of money for them. They're so excited. But once the ecstasy of the sale transaction that's coming together kind of wears off, now what's sinking in is the reality that that cash cow, so to speak, that they had and all those sundry expenses that they were able to take through their cottage industry business, things that they wrote off such as dinner expenses, all of those things that could be of a business nature are no longer deductible, and they're finding themselves in a little with a sense of uncertainty. What do I do next with this money that I've got from the sale of my business? How do I diversify? How do I get a decent risk-adjusted rate of return? What's the right diversification technique for me? How much cash flow can I develop over time? And what's that going to look like when you actually get into the granular details of the investment? So those are the things, Mike. I think it's very difficult for a business owner to go from building the business, applying yourself to your trade and having success, and then making that pivot from being successful in business to preservation of wealth and income planning, which is really the core of what we do as a practice, is help people build out their diversified income streams so that they can thrive in retirement, not just survive. That's what we love to do. And so we're delighted here sharing that with you. But if you're a business owner and you haven't already thought about seeding money away outside of your business to build your nest egg, or if you're at the place where you're in the process of looking to or you're engaged, you've entered into a purchase or sale agreement, or you're selling your business and you want to start to monetize those assets, asking yourself the question, what's next? What's next after I get this money? Then those are some things we can help you with.
Yep, absolutely. And I want to touch on what's next because every once in a while you see a statistic out there that kind of catches your eye. And one I've been saying since we've worked together is kind of how annuities are pensions for yourself. And one of the most recent surveys I saw was 80% of people, roughly, aren't necessarily a fan of annuities.
That's right.
But when you ask the same people if they'd like a paycheck for the rest of their life,
they'd be on
the
board
same
with that.
respondent is 80% would like that paycheck for life. So it seems like there's a lack of education out there because annuities can act as a paycheck for life.
That's right.
For some people, not everyone, but most people are turned off by the idea right when they hear the word come out of someone's mouth without even giving it a shadow of a doubt or further educating themselves it's right for them.
Well, there's no doubt about it, Mike. And then you have Ken Fisher out there who has $65 billion in assets under management. He's a billionaire, and he basically promotes this advertisement that says, I'd rather die and burn in hell than sell an annuity. Now, while his point is well taken, he's a billionaire, and I'm sure that in his portfolio, he doesn't necessarily need an annuity. Do you? I don't know, maybe. It is a source of predictable and long-term income. And I'll tell you what, Michael, right now we're in a very low interest rate environment. We're going back into that again. If you go around the world, there's $16 trillion in bonds that have negative yields. If you convert the US dollar to the Japanese yen and invest in their equivalent of the 10-year US Treasury, you lose about 20 basis points or 0.20% a year. And there are banks in Switzerland right now that are charging depositors to hold over $1 million in deposits in Swiss banks. It's a crazy world out there. Corporate bonds don't pay very much. Treasuries have appreciated nicely because interest rates are scheduled to go down, but the 10-year still is only paying about 2%. So annuities, in the right sense, are kind of like an open-ended bond fund that have no maturity date with an equity kicker where they can create a high level of sustainable income, kind of like a convertible preferred or a corporate bond fund, but there is no maturity date or date when you're going to get your principal back per se, so you can keep it open-ended and in fact create and collect a lifetime income. And when I say an equity kicker, you can participate in the S&P 500 or JP Morgan Mosaic Index or different FTSE, which is the European stock market. You have the opportunity to protect some principal, but have an option to get a small part, although it's a capped amount, of the return on a broad index that can give you a better total return than if you just had the income from the annuity itself in certain cases. So in this environment, I think a lot of people have to ask themselves the better quality of question, which is, what am I looking for from my assets? Am I looking for income? And if so, how much? What I always suggest you do is figure out what you need to provide for your retirement lifestyle. Then give yourself credit for Social Security and albeit any pensions. If you are a veteran or a U.S. naval officer and you get a pension, give yourself credit for that. After reducing the amount you need by the money that you know you're going to have, such as pension and Social Security, that's going to leave you a potential budget deficit, pardon me, or income gap. And that's the amount that you have to reverse engineer a plan for to have diversified investments to give you that number, to cover the gap or the deficit. Annuities can be one choice. There's other ways to do it, alternatives, etc., mortgage, real estate investment trusts, some high yielding dividend stocks. But at the end of the day, you really have to have a plan for cash flow, because if you don't have that, you always walk around with this uneasy, awkward feeling about when's the next shoe going to drop. Because if you're worried about the direction of the stock market and how that's going to affect your day-to-day enjoyment in life and whether or not you can pay your expenses, then I would suggest to you it's time to think about a better overall plan.
Yes, absolutely. If you are pretty much just going about your day-to-day, worried about your investment assets and exactly where they're going to end up first thing tomorrow morning or at the end of the day,
right,
and you're losing sleep at night, that's exactly why some of these strategies might be right for you. Because at the end of the day, Dad, it's not exactly how much the assets accumulate to be. It's about your quality of life, how you feel when you go to sleep, and really how much income those assets are producing.
Sure.
Especially when it comes to retirement, because we both know most people's expenditures actually go up.
That's right.
Those first couple years of retirement,
They
and
sure
people
do.
are
You wanna
scrambling.
travel? Yep.
People want to travel, and they're scrambling to figure out where they can pull this income from.
Sure, and the stock market is such a gamble in so many ways. You know, there was an article the other day in Barron's, which I love to read that over the weekends, and it talked about Macy's, which used to be, you had the Macy's Thanksgiving Day Parade. Who didn't love that? I mean, it's like a tradition up in Manhattan. And Macy's stock, they missed their earnings estimates, they're closing stores, their franchise is just in tatters. It used to be such a storied, honored brand. Everybody loved Macy's. Now it pays a dividend yield of 9%, and the stock is trading at a low multiple. But guess what? At $15 a share, if it sold at $9 a share, the real estate that it owns in Manhattan is worth more than the whole ongoing enterprise. But the question is Macy's even going to be in business when they're losing business and overstocked inventory is being sold at these discount merchants such as a TJ Maxx or a Burlington? The bottom line is, how safe is that dividend? And the answer is nobody knows, because Macy's may just be at the end of the retail carnage, just another chapter of a company that's going to end up in bankruptcy, in the bargain dustbin bowl of businesses that were once honored and heralded as awesome franchises that now is not even maybe necessarily an also ran. It may just be an out of ran. So we like to make sure that you really think safety first, right? Rule number one is don't lose money. Rule number two is see rule number one. And also that you grow your money enough to beat inflation if you're rich enough. How rich are you? Do you know? And if you're rich enough, then it might be foolish, I would suggest to you, to risk money you can't afford to lose to chase after money you don't need to have. Do you have enough money? Will help you figure out if you have your number. And you have to try to grow your money enough to beat inflation, because groceries and everything gets mostly more expensive over time. And then diversify through multiple strategies that are non-correlated, meaning if one area is doing poorly, another's making up for it, right? Think about diversified ways to cultivate or curate robust income to cover that gap. Remember, if you need $80,000 a year and you're going to have $20,000 from Social Security, take the $80,000, subtract the $20,000, you still need $60,000. Oh, wait a minute, you get $10,000 a year from that Asheville home outside in Maggie Valley. You Airbnb it after all your expenses to pay for the bookings and property management. You're netting $10,000 a year from that. Take that again, deduct that $10,000. Now your 60's 50. You've got no other income. Now you've got to have $50,000 in retirement of income. If you have no pension, where are you going to get it? What are the sources? What are even the options to consider to optimize your income and make sure that you have sustainable income, that whether the market goes up or down, you thrive? And those are the kind of things that we really want to educate you about, and the reason that we're excited that you're watching this program today.
Absolutely. And I want to go back to a couple years ago before we head on out of the show, because I know you mentioned dividends and stocks and how they can't be exactly the most predictable when it comes to your retirement for income.
Right.
Although it's good to accumulate your assets through your stock market, you should, like you say, start to schnitzel a little bit away when it becomes when it becomes more of a situation of you can't afford to lose. Maybe it's best to start schnitzeling some away.
Right.
But I remember we were at an event, I don't know if it was Boca or City Fish Market or one of those places, but a gentleman actually tried to tell you that dividends were guaranteed. I don't know if you recall that.
Yeah.
You guys had a little thing there where he kind of wanted to teach you about dividends, which we both know dividends are not guaranteed.
Sure.
They can be cut any day of the week.
Absolutely.
The company can go out of business.
Sure.
And they could just decide that they're going to not cut them, but pull back on the percentage. So you can't really rely on dividends overall as your only source of income in retirement.
No, that's exactly right. Dividends are basically distribution of pre-tax profits, or I should say after-tax profits, because the company's going to pay tax, and then you, as the shareholder, when you collect your dividends, they're taxed to you at qualified dividend rates usually. But at the end of the day, dividends are part of a distribution of profits to the equity owners or stockholders. You can be diluted, preferred or creditors come before you. Companies even like GE, recently their stock price has been hammered for so long now, they cut their dividend because they don't have enough cash flow to meet their obligations. When things like that happens, you have no control over it. So dividends, while they are one constituent part of your aggregate total return, they're not the end-all be-all. that may just be one part of an overall broadly diversified strategy. Some people like the dividend aristocrats, which are stocks that have had a proud heritage over 20 or more years of raising dividends through robust increasing profit margins and basically robust business operations and profitability. But at the end of the day, you're absolutely right. Dividends are not guaranteed. That's why the only free lunch is diversification.
Yep.
Because you cannot, no matter what investment you make, you cannot know what the outcome of that investment is going to be with 100% certainty. So you've got to take advantage of the only free lunch in investment, which is diversification of your income sources, or having income sources that have some kind of requisite guarantees that essentially kind of are a offset for maybe not being as diversified as you'd otherwise like to be.
Yep.
But a lot of good thoughts, Mike. A lot of great thoughts.
And it all goes back to my new rule number 1, which is now rule number 1 is going to be get educated, because if you want to be diversified,
that's right,
you have to be educated. Then we'll make the new rule number 2 is don't lose money. Rule number 3, go back to rule number 2, because education is key. If you're going to diversify, if you're going to start investing in things you're not really familiar with, it all goes back to education, because that really is going to help you sleep well at night. Most people just want to know that they're getting good care taken of them, and that they kind of understand the workings of what's going on.
Sure.
Even if they don't understand the high level execution strategies, they just want to know that they have some semblance of an idea of how their money's working for them.
No doubt about it, Mike. It's well said. And so, folks, we're going to continue to come for you, come not for you, but to you, to try to bring you information and insights that will be helpful to you in your journey toward an abundant retirement. It won't always be here from Chicago. We'll be back in West Palm Beach soon, but we want to thank you for joining in with us today, and we hope you'll continue to watch and have a magnificent evening. Goodbye now.
Hey everybody, thank you so much for tuning in. Really appreciate it. Hope you enjoyed the videos. If you got some more free time, I know you do, make sure you check this video out right here. And if you don't like that one, make sure you check this one out too, or just watch them both. See you guys soon.